Hello to the EconBuff podcast. I'm your host, Lee Stitzel. With me today is Dr. Eric McKee. Eric is a professor of finance at West Texas A&M University. Eric, welcome.
Yeah, thank you, Lee. Thank you for the invitation. It's real pleasure to be here.
So our topic today is the GameStop short squeeze, the RobinHood trading app, and all the stuff that happened on Reddit. And really the reason that I wanted to bring you on today is to get into this technical finance stuff. I get questions from my students, what's going on here? And I have these grand economic answers to them. But I think there's room for a lot of exploration of the interesting details that are going to be happening. So I want you to start us off with, this episode is centered around this idea of short trading or a short. Can you tell us what short trading is?
Yeah, so normally you would buy low and then sell high. And with short trading, you sort of do the reverse. You sell first at a high price, and then you buy it back later, hopefully at a lower price. And then you get your profit that way. Now you're selling shares you don't actually own, so you have to borrow them from someone else who currently owns them, and you have to pay interest on that. It's generally a much riskier, much more a strategy that only very sophisticated or professional traders really should be doing or do at all. So that's sort of what short selling is in a very broad context.
Is this like the opposite of going long? So when people say going long, they just mean I'm just going to buy it and then the price is going to go up and then I'll sell it and benefit. That's going long? Or?
That's the normal way you would go long. There's some other exotic ways you could go long or go short, but yeah, you're basically either buying the stock and hoping it goes up, or you're selling it and hoping it goes down.
So the reason that short trading is really like a sophisticated thing is I'm somehow selling something I don't own. So I think everybody's alarm bells went off when you said that. You're like, wait a minute, I sell it first? Don't I have to have it before I sell it? Can we delve into that borrowing thing a little bit? So you have this idea and you say, I think this stock's going to go down. So I need to sell it first. So if I want to sell it, I got to borrow it. And Lee's over there and he's got a stock. What happens?
So if you're you have a brokerage account, a lot of times how you'll be able to short sell is other people who have accounts of that broker own stock in that company, and the broker can take that stock, lend it to you, and then you sell it and have an open position with the brokerage account or with the brokerage firm. And then if that person says they want to sell their stock, there's other people who also own that stock, and then they just sort of swap shares to make things good. For the big guys like the hedge funds, they will tend to have a different way of borrowing shares. But if you're trading with a brokerage account, that's probably how the short selling would work for you.
So if we're talking about a hedge fund and having another way to go about doing this, are we equipped to understand that? Could you explain that to us, or do I need to walk us a little bit further down the path before you open up that can of worms?
Yeah, I don't know too much about where they borrow from. Like, hedge funds tend to try to be really secretive about their strategies, because if it gets out, then all the other hedge funds will pile in and they won't be able to make money anymore.
So are they specifically trying to hide from hedge funds, or are they also trying to hide from sort of a more general use of that information? And are those hedge funds now adding Reddit to their list of people to hide from?
So they definitely try to hide from like anyone who might be trading on it. I mean, hedge funds are probably the ones who could most easily exploit that information, but more traditional investors are also going to be trying to copy them too.
So I'm going to go off in the weeds for a moment, because this idea just popped into my head. So you're a PhD in finance, so in theory, like a hedge fund could come hire you. Is part of your compensation structure going to be centered around secrecy? Like they'll say, we'll fire you if you let our secrets out, in order to build this kind of what'd you call it? The secrecy that the hedge funds are gonna.
Yeah. So first, there are quite a few hedge funds that hire PhDs in finance. There's one of the largest ones, AQR, is really well known for doing that. So there's a lot of PhDs in finance who go into industry, work for places like hedge funds. I didn't try to get a job there, so I don't know the whole details, but they probably have some sort of non-disclosure agreement that they have to sign if their trading strategy is secret.
So I'm thinking like an economist and say, that must be the type of thing that we would have to pay more to get people into that type of position. I could be wrong about that, right? Because the secrecy aspect could be something that people who work for these funds, they really don't care either way. I'm sort of thinking like a risk premium type thing. I'm using that like in a finance sense, but if you're working in a job that's more likely to get you injured or killed, then you're going to be paid more in order to do that. That's like a really funky way to use risk premium, I guess.
Yeah, they definitely get paid a lot more than if you go into academics.
But is that
as a
because
PhD.
is that because those are like very highly skilled people working in very technical positions? Well, obviously it must be, but there's also this element of secrecy, you think?
I don't know.
Okay, we're in conjecture.
Yeah,
we're
I'm
in
not
conjecture
a
land.
labor economist, but
Yeah,
it's probably both. It's probably a mix of both. Would be my guess.
That, like I said, off in the weeds. Okay, so what? I'm very interested now. So it's actually, I think, relatively understandable to think about what the short trading is and what it's doing, and kind of like why it would work. I think there's a idea out there that short trading is somehow like riskier, or it's more like gambling and less like investing. But to me, at least the description that you've just given us, it is a relatively intuitive thing in the sense of, if I think a stock's going to go up, how do I benefit from it? I buy it now. If I think the stock's going to go down, how do I benefit from that? Short trading seems to be the answer to that. Can you comment sort of generally on this idea of investing versus gambling and how short trading fits in that?
So it's definitely riskier. One of the big reasons it's so risky is there's no upward limit, no ceiling on the price of the stock. So you could have a stock price go up to 1,000 or 10,000, and you would still have to buy back that share to return it to the person you borrowed it from. And if you bought, the worst you can do is the stock price goes to zero. So there's a sort of an unlimited potential loss.
So the people that first got in when GameStop stock was whatever it was, $6 or $7, and they could lose, if they bought 100 shares, they could lose $600 if it went all the way to zero.
Yeah, there's limited liability. You can't lose more than what you invested. If you buy, if you short sell, you could lose you could lose everything.
So, what's the mechanism that then eventually forces me to buy back the stock, and at what price does it happen? Is that only a time constraint? You've borrowed the stock from, and so therefore in 30 days you have to return it? Or are there other things like you borrowed my stock through the brokerage firm and now I demand it back, and you're like, but wait a minute, it's $400. I don't buy it back now. How does that work?
So so it depends on the terms of your loan contract basically, but it's really standard to have some sort of predetermined price limit, and then the broker will call you up and say, hey, you need to put up more cash as collateral, or you need to close out your position. And if you don't put up more cash, we're going to close out for you, and they're going to be really mad at you if you force them to do that.
So this is where the squeeze idea comes in.
Yes, that's part of how you get a squeeze. Yes.
So describe to us the mechanics of the squeeze then, which I think you've laid the basis out for us, and then we're going to want to come around to talk about how this ended up being a squeeze. So in theory, there was some number out there, and they were saying if GameStop stock ends up getting up to $20 or something, then we're going to have to make you put up more cash on your short. Are there layers to that? When we get to 100, do they call you again and say, okay, now you got to put up more?
Yeah,
200.
They do.
Okay, so how do those increments get?
So it's based on so it's a loan that you're taking out, and it's a pretty risky loan because that unlimited loss. So the person that you borrowed from will generally force you to put up some collateral, some cash in an account that you can't touch, and if everything goes horribly for you, they will just seize that cash and use it to close out their position. So it's kind of like you have a home mortgage, your house is collateral. If you don't pay your mortgage, the bank will just take the house and use that to make good their loan. So something like that. But when you're trading with the stock market, things can move really quickly. So the broker wants to make sure that collateral will be enough to cover them, so that some percentage limit will be set in that loan term. And if your losses get too high, so that most of that collateral is going to be eaten up just taking care of those losses, then you'll get what's called a margin call.
So the margin call is the part where they call you and say we need more collateral.
Yeah. So back in the old days, couple decades ago, you might get a phone call. Probably now you get some sort of electronic requirement. But then you either have to put up cash, or you close out the position, or they force you to close out the position.
So if I can step back to kind of the whole cycle, which we're still in the middle of, so it'll be interesting to see how this shakes out. And we're going to ask you sort of where things are at as they stand when last we knew them. But so in theory, like I know GameStop stock is not going to sit at 400 for the foreseeable future. So they call me, give me a margin call, and say, hey, GameStop stock is up to $100. You need to put some more money up. And I say, ooh, I really don't want to do that, but it's got to come down. And then they call me at 200, 300, 400, etc. And if I can just keep putting up the money, eventually I will ride this out and it will come down, and maybe it doesn't end up shorted, but it's really more of a liquidity problem necessarily than an actual way the stock will end up valued.
You need to have enough cash if you want to keep holding on.
Okay. So I do want to talk about the scale of this whole thing eventually, because I think that's what kind of blew my mind with the whole thing is. I think I actually said this to my students when they brought it up, and I was like, how much money can a hedge fund be losing on GameStop? And that turned out to be a really stupid thing to say because of what you've described already, and then I've seen some of the numbers since then. So I went back and talked to them actually this morning and kind of described some of the stuff that as far as I know it, which is why I'm really glad to have you here today. So are we good on short trading?
So let's keep going with the short squeeze.
Okay.
So they happen on occasion, and normally what happens is this stock is being heavily shorted. Lots of people think it's going to go down in the future, and so they all are piling into the short selling side of the trade. And then there's some sort of positive news about the company. There's buying pressure, pushes the stock price up. A bunch of these shorts get margin calls. Some of them don't have the cash to put up more cash, so they have to close out. They have to buy to return their shares. That's more buying pressure, and it turns into a positive feedback cycle where every time more shorts are forced out, they buy, pushes the price up more. There's more cash requirements on the remaining shorts, and it just keeps going until all the shorts who didn't have enough cash have been pushed out. And then the stock price crashes back down because it's way higher than the real value of the firm.
So this is something that we observe. We're going to probably get around to throwing around words like market manipulation here, but you've just described a relatively organic way for this to happen, given the existence of a fairly high number of shorts. Correct?
Yes, and actually, like in the case of GameStop, they did have some positive news. So there was a big billionaire investor. His name is Ryan Cohen, I think. He was very successful at in e-commerce. He has like a Chewy.com, like a company that sells pet food. And he made a big investment in GameStop. He's about, I think it's about 10% of their market of their shares he owns roughly. And he got himself put on the board of directors. A couple of his buddies who are presumably going to vote with him are on the board of directors. So that was kind of the positive news that started pushing up the GameStop price. And then once that happens, because it's so heavily shorted, there's all that additional buying pressure from the short sellers who have to cover.
So I'd not heard that. I've soaked up this story in quite a few different venues, and I hadn't caught that bit of news, which is very interesting to me because the story is, here's this Reddit community and they do this, and then they sort of spark this on your own. But you're actually saying they're piggybacking on a little bit of...
Well, I think, yeah. So I think so at least the initial thing, there were people on that Reddit community who thought it was undervalued, and they bought and they were holding, and then more people were piling in, and the stock price is going up, and that was sort of causing.
So the more people that are piling in, is that because of the Reddit community, or is that because of the Ryan Cohen news?
Probably both. Probably both.
Okay,
yeah.
so this really is a confluence of events.
Yeah, it wasn't just retail traders piling in. There was some legitimate positive news for the company. Yeah.
So you're not going to have an answer to this because it must almost by definition be a mystery. Why would a billionaire buy GameStop given what it looks like the future of that particular retail brick and mortar?
Yeah, I can't read his mind. He probably thinks he can sort of take over the company, and he's already partially taken over it. If he can continue to change the company's direction, he might be able to become the next CEO or something like that. And maybe he's trying to move that company into in a totally different operating model where they do more e-commerce or something like that.
That's kind of what I was
But
wondering.
what his exact plans are, yeah, I'm not him. So
But he has some battle plan there.
he,
He's probably
presumably he's not just throwing away his
Yeah.
millions of dollars.
Right.
But
So the next question that I wanted to ask you is kind of the other side of the equation. We've talked about a little bit about Reddit, and we've talked about hedge funds. We've talked about shorting. I think the listener, sort of the average person that's thinking about this kind of thing, maybe doesn't have a super clear picture of what a hedge fund is or what it tries to do. Hedge gives us this kind of intuition as to they are hedging. They kind of they play it safe, and this is a good place to put your money. But we also understand that this is multi-billion-dollar operations and whatnot. So give us a sense of what a hedge fund is and what it does and what kind of strategies they employ and how they might compare to different types of financial intermediaries.
yeah, so if your listeners are familiar with mutual funds, hedge funds have some similarities to them. So they have investors basically buy into the fund, and that money's pooled together, and the manager or managers of the fund then try to invest that and generate returns for their investors. And that's what mutual funds are doing too. They're pulling together the investors. One of the big differences is that hedge funds are sort of catering to the very wealthy investors as well as the financial institutions. So you have really high minimums to buy into a mutual fund. Buy into a hedge fund. Like $1 million is kind of like the bare minimum, and usually they'll be a lot higher. So you have to have $1 million in cash that you want to invest in a single fund
So when
to
the
buy
Reddit
into one of these kind of things. Yeah.
when the Reddit community gets together and says they're sticking it to the rich, if you're getting a hedge fund, you sort of are getting those people.
So yes, you're also getting like the pension funds and the insurance companies who ordinary people are the ultimate beneficiaries for those companies. So it's not just the rich people who are going to be hurt by killing off a hedge fund. It's anyone who invests in it, which most big institutional investors will have at least a little bit of their portfolio in hedge funds.
One of the few human interest stories that I had seen in the run-up to this was somebody essentially talking about this idea that said they had their own, retail investor, they're doing their own thing, and they had looked and they thought, well, actually GameStop needs to go down, so they were in for a short. And of course not very much money compared to what the hedge funds are doing, but then they kind of get caught up. So there definitely is, no pun intended, collateral damage here.
Yes, absolutely.
So why is a hedge fund doing things like shorting GameStop stock?
Yeah. So hedge funds are also like mutual funds. They have a really wide variety of the investment strategies they choose. Just they're called hedge funds just based on their structure, but they can do things like they try to find stocks they think are going to go down and short them. They can buy long. They have a lot of different strategies, and a lot of them are hidden strategies. We don't really know what they are, but we know that there's a huge ecosystem of different strategies, just like the mutual funds.
This is why my initial response was, why would one stock in a very diverse portfolio like a hedge fund must necessarily be holding? How could that possibly be so damaging? And that's obviously because I didn't have this sense of that a short can go terribly wrong with no limit, with no ceiling.
That is a big part of why they would potentially lose so much for that. And the goal for the hedge funds, at least how they were originally intended to be, is sort of you get returns that are not correlated with the most other common investments. So you have sort of a hedge on the rest of your portfolio if you invest in a hedge fund. And if your listeners know about the importance of diversification, that's kind of why the big institutional investors would want to have a small amount into hedge funds, not because they're going to generate huge returns and make them super rich, but because those returns are going to be not going to go down at the same time everything else goes down. That's the idea.
Yeah,
it doesn't always work, but
all my money are in these large diversified mutual funds. I suspect GameStop's not big enough to be in any of them, but maybe I'm wrong. I should go check and see if I can tell to see how much money this GameStop thing is getting or costing me.
If you look at the prospectus of your mutual fund, it will tell you what index that it's trying to track. And if it's, say, tracking the S&P 500, GameStop's not in the S&P 500.
Right.
If it's tracking like the total market, it might have included GameStop.
I think I basically have one of each of those, so we'll see. I have to go.
Yeah, so you
I'll
might
have to
so
go
you
look.
might have had some exposure to GameStop.
Yeah.
I did too, because I have index mutual funds like you do.
Yeah, I've already said this on previous podcasts. So listeners are tired of me saying it at this point, but I have a very vanilla investing strategy. I get big, low cost index funds that track the whole of the market and let it do the work over a long period of time. So
Yes, and the finance research is very much that's the kind of the optimal way to go. You can try to add more things to get more diversification, but there is sort of diminishing benefits from doing that. But if you're a really big player, like a big financial institution or wealthy billionaire, it's then worth your time to go out to the extra things like hedge funds.
So I kind of want to think a little bit about maybe we should call them like the protagonist in the story, the Wall Street Bets group, and maybe even some of the like individual people. I guess Wall Street Bets is just a subreddit. Is there more to that story, or it's just a community of Redditors gone rogue?
Yeah, I don't know how familiar you are with Reddit.
I'm quite familiar with Reddit, but not at all familiar with Wall Street Bets, and I'm going to go out on a limb and guess most of my listeners have a working knowledge of Reddit.
Okay, so I don't have to try to explain what a subreddit was. But yeah, so it's kind of the name. Like I think their investing strategy, if you could call it a strategy, is sort of more like gambling than you would normally think of as investing.
I manipulate my elections for my 401k less than once a year, probably. Okay, maybe slightly more than once.
Yeah,
a year.
they definitely talk about like trading daily or weekly kind of trades, which is usually not a good idea for retail investors. They usually lose a lot of money if you do that.
So the key thing here to understand about Wall Street Bets is that these are people who are maybe used the word gambling because it literally has bets in the title.
Yeah.
They're there to more of a poker mindset and less of a long-term investment strategy mindset.
That is the sense I got when I was looking at the subreddit. And yeah, there's others like subreddits that focus more on like the buy and hold for long periods of time because you think the stock is undervalued. You're not trying to day trade or something like that.
I had never seen this subreddit before, but I've seen the more, I don't know if I want to call them mainstream necessarily, but the more conservative ones before, personal finance advice, those type of subreddits.
I looked at that one. That's a very nice one for
and
personal finance.
There's probably an entire podcast in just this kind of topic alone, how these kind of things develop their own culture. And I find that Reddit is very interesting for my hobbies and excruciating for my profession. So anything economics, you have the EconBuff stamp of disapproval on anything that has the word economics in the subreddit because those are unbearable. So I don't know how the finance ones that are maybe a little more academic, I don't know what those ones are like. But the ones for my hobbies, powerlifting, chess, poker, golf, those kind of things, those are fun and those are good, and I tend to like those. So did you have a comment about the finance ones? Or?
Oh, well, like the personal finance Reddit, as far as I can tell, they tend to do a really good job of like.
Is there like an academic finance one?
Of recommending good things for people's personal finance. There's some like investing subreddits. I don't really look at those very much. I don't know if there's one for like academic finance PhDs. There's a subreddit for pretty much everything, so maybe there is, but
it has 417 members.
It has
probably
barely anyone who posts on it.
Right. So what I was going to say about that is what's interesting about these is they develop their own culture. Sort of, we might call that a subculture.
Yeah.
And these, like the personal finance one, is good because in a sense the things that have risen to the top and become the type of things that you will always see if you go there, typically I would evaluate them as quite good advice. They're not telling you to take out a credit card to pay off your other credit card to pay off your other credit card, right? They're telling you to do mostly sensible things there. I'm trying to think if I've ever seen something, and if you say something dumb, you will get shouted down, which is sort of a double-edged sword, I suppose. But you develop things that I would think, maybe kind of in general good, but can can have unintended consequences would be the way to think about it. A good example of this is like the powerlifting subreddit, because in some sense there is a really good habit there of, if I go on there and I criticize an elite level lifter form, then I will be just mercilessly teased. And there's some sense in which that would be well deserved. But it also has this consequence of, one of the things we might like about sports is, yeah, at the end of the day, I can't throw the ball as well as Aaron Rodgers, but I should be able to compare Aaron Rodgers' throwing technique with Patrick Mahomes' throwing technique, and then that be like a discussion that you and I have as a sports fan.
Mm-hmm.
And because they're so militant about not allowing people to come in there and criticize somebody who is the best at what they're doing, the casualty of that becomes this other type of discussion that powerlifting as a sport we might like to have. And so my understanding is, to bring this full circle back to the Wall Street Bet stuff, is you do have kind of an odd subculture there. Can you give us a sense of that?
Yeah, I don't know how odd it is for Reddit, because there's a lot of kind of lowbrow sort of subreddits. But if I was looking at their subreddit the last couple of weeks, and there's lots of like memes and one sentence kind of posts that are not very interesting, or they're just literally just a meme, and that's it. Yeah, and they also tend to like give out financial advice, which is something that's sort of legally and ethically dangerous to do. And then they give kind of obviously fake disclaimers like, oh, I'm an idiot, using more vulgar terms than that, or I just like this stock, don't take my advice. But it's kind of obvious they're not really very serious about those disclaimers. I know the SEC is sort of investigating some of the bigger players in the Reddit, and I don't know if those disclaimers would stand up in court. They might not. They might be able to stand up in court. But my impression was that it was pretty obvious they really were giving financial advice, and their disclaimers were kind of pretty weak. Not convincing to me, anyways.
So, there's this part of, and this is a question that I had for later on, but I think it inserts very well in this part of the discussion, is what's the regulatory fallout? What are the consequences of these things going to be? And should the SEC be going in there and pulling my Reddit account with my silly Reddit name, and then like prosecuting me on these things? Now, I think you've brought up a very serious point, which is giving wanton financial advice is a somewhat serious thing. There's another part of me that says one should be careful taking any advice that you're getting from Reddit, because the point of that is not to get
truth,
not to
accuracy.
get oh, that's a good way to put it. It's not necessarily truth. It's entertainment.
Mm-hmm.
Can you comment, sort of, I don't know if there's a way that you see that going, but just sort of comment in general on this idea that you're going to have the SEC investigating people on Reddit for giving, air quotes, financial advice?
Yeah, so I'm trying to mind read politicians and regulators here, so I probably will be wrong. But there definitely is reports that they're investigating some of the people. There's one guy who had a huge amount in GameStop, and he was making videos on YouTube as well, where he was saying his case for it.
Kendall Gill.
Yeah, his name was sort of exposed, so people know who he is. And probably the big reason the SEC is really interested in him is because he was originally working at a financial institution when he started sometime last year, when he was first started making those videos. And so he had sort of a license, a financial credential, and he was working at a financial company, so that makes it a lot more serious than just some random person on the street telling you what stock you think you should buy.
This is a serious topic, though. If I don't know, there's probably and I know this for a fact, because anytime somebody hears that I'm an economist, the first question I get asked is, what's the stock market going to do? But if I get on there and I make my own personal private account, and especially if I don't advertise myself this way, but suppose that I did, I'm going to go on there and say, you got to trust me, tomorrow GameStop stock is going to quadruple in value or something. How is that like an ethical concern? How is that something that we would be worried about from that perspective?
One of the things that where you can run into the legal problems here is what we call a sort of a pump and dump scheme, where you will talk up the stock and you're currently long, and then you sell it to the people that you're talking it up to. So it's basically just fraud, and people go to jail for that. The big financial players, if they're caught doing that, the SEC is going to throw the book at them. They're going to, at best, they'll have to pay a big fine. Probably, more likely, whoever was actually doing it will have to go to trial and potentially go to jail.
So one of the things that I had seen when people were talking about this is this idea. I get some notoriety, and then I start a newsletter, and I say, hey guys, this is going on, and then it's a stock that I already hold, and then all my listeners react to that, which inevitably, sort of self-fulfilling prophecy, raises the stock, and then I get out before they do, and essentially I'm profiting off my own people, but it creates this vicious cycle of, well, I told you guys to get in the stock, why didn't you get into it? Look, I made so much money on it, and then everybody else is going, but I didn't make any money on it. Well, it's because I didn't follow his advice fast enough. That's the pump and dump kind of strategy.
Yeah, if you're, it's it can be kind of fuzzy. There's lots of people who write newsletters and make stock recommendations for a living. They do have to be careful about disclosing, do I have a personal position in these investments or not, because of they would get into legal trouble if they did, and they were sort of profiting off of committing fraud by lying to their customers, basically.
Okay, so let's turn this now to the RobinHood platform. So start by telling us what RobinHood is, sort of as a broad category, and then sort of some parts of how it is that RobinHood functions, and then how they make their money, and what service they're providing.
Yeah, so RobinHood is a discount broker. So it's a new discount broker, but they basically have a similar model to what, say, Fidelity, Schwab, E-Trade, TD Ameritrade. There's a whole bunch of discount brokers, and they offer really low cost commissions for trading, and pretty much anyone can sign up and put some money into an account and trade on the stock market. So lots of retail investors use those brokers to do their investing.
What's this about the zero commissions then?
Yeah, so they're kind of a new company. They kind of say they sort of are taking advantage of the smartphone revolution. And, they have an app for their smartphone. One of the things they did was they had zero cost commission, which these discount brokers do compete for customers based on how based on the price of how much you have to pay per trade. I know when I first opened my account, which was back a decade ago, my dad and I, because I was just like 18 or something, we chose the broker based on, one, if they had a branch office close to us, and also two, based what their commission fee was. But if you have zero commission fees, well, you can't really beat zero. So
what if I pay you to come trade on my platform?
Well, I don't know if you could do that.
Seems like a losing proposition for me as a discount broker, huh?
Yeah, so they were out competing all the other discount brokers because the discount brokers were generally charging you like $6, $7, $8 roughly per trade.
Per trade? That seems like a lot.
Well, it used to be like 20 or 30 just
Really?
a couple decades
Okay.
ago. Yeah, I remember my father would tell me stories about how when he was a kid, he would have to, one of his summer jobs for my grandfather was to call up the broker and order trades, and those would have cost $20, $30, $40. It's much more expensive back then than it
Wow.
is.
So that's a really fascinating. There's a lot there that we could potentially unpack. You said branch location, so you're talking pre-RobinHood smartphone type
Oh
of
yeah,
trading apps.
yeah. This was back in.
And then commissions. So
2000
RobinHood has essentially solved both of those problems, and not them, but
Sort
the
of,
class
yes.
of people that
Yeah.
do that.
Yeah, so just I think it was last year, several discount brokers just announced one after another, yeah, we're going to zero commission fee trades, and it's basically because they were getting outcompeted by RobinHood, so they had to cut costs or cut the price to stay in business and compete with them.
So how does RobinHood make money then? If they don't charge anything for trades, it seems like that's an unsustainable business model.
Well, they make money a couple other ways, and all the other discount brokers tend to make money this way too. So the commission fees were maybe about 25% of those brokerage firms' revenue. So they lost a lot of revenue, but they didn't lose everything. So one thing you can do, which is probably the most controversial, is you can sell your order flow to some of the big hedge funds and high-frequency traders. And that's, yeah, again, it's kind of controversial because you're selling that kind of information. It lets those guys profit off the retail investors. But one of the reasons they like having that information is because retail investors are collectively really bad. They make really bad decisions. So if you know they're all piling into one stock, it's probably not a stock you want to invest in.
So this is like the opposite of the wisdom of crowds idea
Yes.
that we talked about in other
Yeah.
places. So
and
there's a truism, right, in the computer science world or privacy concerns. If you're not paying anything, then you're the product, not the. Is that true here? Then?
So that's part of their revenue. They also make money by letting their customers borrow from them. So if you are selling short, you have to pay interest to the broker, and they make a profit there. If you buy on margin, which is borrowing money to just buy the stock, again, you're paying interest. Interest is really high in both cases, and they make a profit there too.
But now, if I go in there and I say I'm not going to do either of those two things, I'm not going to short, not going to buy on margin. I'm going to buy this stock and then sell this stock and buy this stock and sell that stock and just behave like what I think my listeners would consider mostly normal. In theory, the only thing that I'm giving up is the privacy of my trading history.
Mostly, they can also say take the share that you bought because they're holding it in trust for you and lend it out to someone. But yeah, a lot of what they would earn from you is just the order flow. So you wouldn't be their favorite customer. They want the whales who are borrowing lots and losing lots of money in the stock market.
So that analogy to a casino circles around kind of in a distasteful way there, because the casino isn't real happy when you and I roll in with our $20, and then when we gamble $20 and it's gone, we just leave. Right? They want the guy that shows up with $100,000 ready to lose it all and then go back for more, right?
That makes that makes the brokerage firm more money too. If there's lots of people who are treating it like gambling and or borrowing and paying lots of interest, yeah.
So the last thing, before we sort of turn to the outcomes, I guess, as far as we know them so far, is this idea of a clearinghouse. So the episode that I just recorded, we talk about why RobinHood went and shut down trading, and we sort of explore all the different ways that this might have happened, and why, and the motivations, what we call narrative economics, right? But one of the things that comes up in there is this kind of mechanical explanation of RobinHood is essentially forced into doing what they did, which is cap the buying and allow the selling.
Yeah.
Which looks really suspicious.
It does, yes.
Which I would love to get your opinion on. But before you go there, tell us how that mechanical part would work, and what's a clearinghouse and how is that involved in this?
Okay, so when you do a transaction, you buy a share of stock. There has to be like a legal transfer of ownership of the share from the seller to you, and that takes a couple days generally. We call, in finance, it's called sort of settling the trade. So if you say sold your share of stock, the cash will show up in your account, but usually the broker will say, well, you can't withdraw it yet because we haven't got the cash from the trade, it hasn't been settled, or they sometimes will let you like buy something new with it because they sort of will put their own cash in and then sort of make good after a couple of days, but the trade isn't fully complete yet. And the clearinghouse is sort of a third party who will sort of take kind of like collateral from both parties and act as a sort of mediator. And once the trade clears, they'll just send the appropriate amount, the appropriate cash or stock over to the right person. So it's a little bit like say if you escrow account for your mortgage, you paid, you put some money in there, you're required to do that. And then they release it to the right person, after the documents are signed or things like that. So it's kind of because there's some lack of trust between the parties that you have to have a third party to handle that.
So this is like, we would understand this if we've ever bought or sold a car or house or something.
Yeah,
like
because I bought a house when I moved here this year, so it's very fresh in my mind because we had to use an escrow account when we got.
So it is that same type of idea.
Sort of, yes.
And so I think one of the things that accompanies this question is, why do we have to do this for our online trading? Which I think you've already essentially answered that question. But I think people have this idea of um, money that's being traded hands digitally, or things that are being kept track of digitally, is somehow less real than if I had to walk over a $100 bill and you had to hand me a piece of paper.
Yeah, I mean, emotionally, it definitely seems different, and it feels painful for me, at least, like to have to, even if I take the credit card out, it feels painful for me. But I'm kind of a weird, super frugal person like that. But yeah, taking out the cash, or like having to hand over the check does make it feel more real. But yeah, there is an actual transaction going on, and there's legal requirements. You have to sort of transfer ownership, and that does take some time. Maybe it could be made faster and more efficient. That's something I'm not really an expert in on, if you can do that. But what we have right now is what we have right now.
One of the things that personal finance people will advise you, right, is you make the budget and then you transfer the money that you're going to have for eating out into an envelope, and you carry the money around, because it gives like this increased psychological barrier to hand over money than it is to swipe it on the credit card.
Yeah, that's kind of a behavioral finance sort of thinking. And yeah, I mean,
You think that still holds? I'm getting way off the weeds now,
for
but
investing, or just for personal finance?
for personal finance behavioral.
It seems to work. I mean, it probably doesn't work for everyone. Some people probably it doesn't feel any different. But if for on average, or even just a large minority do, then it's probably good advice to give people.
So you and I are roughly similar age, right? So I'm about to be 32 here in a couple of weeks. You're a little younger than I am, but I have never really developed that. And so when I've tried that type of strategy for budgeting before, I wouldn't describe myself as super frugal, but I don't really have. I'm not one of these free spenders who has to rein in his budget. I kind of have money for this and have money for that, and that's how I do it. But I never established that personal psychological thing where if I've got money in an envelope, that's because it's meant to be spent. And so I never got the psychological pain. It's almost worse. I might go through the cash quicker because my brain is like, this is for spending. But the card is attached to my actual bank account, and that's where the money I need to keep is also kept, right? So I got to be more careful with that. Now maybe I could just be weird, but it's the fact that you brought up this idea of actually having to take your credit card out causes you more psychological distress than maybe clicking buttons on an app would. Can you comment on that?
I mean, for me personally, it's not that I really use those kind of behavioral finance strategies. It's just that I don't have very expensive hobbies. Like, I don't go out drinking ever because I don't like the taste of alcohol. So that saved me a lot of money over the years. I mean, it's just sort of your personality, how you were raised by your parents. My parents were very frugal. They passed it on to their children. I'm not sure where else you were going with that.
No, I was just sort of in general commenting a little bit of that. The listeners at home can, when you hear this, you can get in the comment section there, and you can tell us whether it's more painful for you to pay with credit card or with cash. So it's always good to have cheap hobbies. I took up golf this past summer for sort of obvious reasons, because it's an outdoor sport that you can do and be far away from people. But not that I'm particularly militant about such things. It just happened to be expedient. That's not an inexpensive hobby, though. So
yes,
if you're going to stay away from alcohol, stay away from golf too, I guess. Okay, so do you have more to add to this idea about why Robinhood would stop trading on GameStop and some of the other stocks, or do you really think it is that clearinghouse and collateral example?
So there's kind of a conspiracy theory that subreddit was sort of thinking that Citadel, who is one of the high frequency traders that buys the order flow, and they're an investor in Robinhood, that they also have a small stake in one of the big hedge funds.
Is this Melvin?
Melvin, yeah.
Okay.
Yeah. And so they were putting pressure on Robinhood and I guess all the other discount brokers, because all of them were doing the same thing. Yeah, I don't think that's really true. I think it's because of this clearinghouse. Normally you would put up a really small fraction of the actual cash value of those shares, but because of how risky things were, the current clearinghouse is like, uh-oh, we need to have more
Right.
collateral here, because it's much more likely that one side of the trade is going to be unable to fulfill their promise that they're going to deliver. And actually, another thing to add there is, if you have your customers buying and also selling, those sort of net out, so you can kind of not have to worry so much about the clearinghouse. But if everyone on your app is all buying and not selling, then you're going to have a really unbalanced need for cash.
That's really an interesting
So
observation.
that's probably one of the reasons they would restrict buying, because they have to put it cash then. But they're okay with you selling because everyone's trying to buy, so they're not too worried about the collateral in that case.
So the fact that it looks bad that they cap the buying but allow the selling also has a mechanical explanation.
Yes.
Okay,
Yeah.
I love it. So
Yeah, and we know they raised tons of cash. I think my personal impression was that, like, they were probably really close to bankruptcy, and if they hadn't done the financial company equivalent of pulling up their couches and digging around for quarters, they would have gone bust.
interesting. So we've already kind of mentioned the pandemic in some of these different sense. But one of the reasons when you and I were talking about putting this episode together, one of the things you were interested in talking about is the role of the pandemic here and the accompanying stimulus checks. So does this episode happen if we saw all the same conditions except those two things, but in 2019, say?
So I think the zero commissions, making it free to trade, had it played a role too in making it really easy for the retail investors to pile into whatever stock they want. So that's probably a big part of how this is able to happen. But yeah, the pandemic, people are sitting at home. Another thing is that there's lots of people who bet on sports, and those sports events are not happening, or it's a lot harder to go to the bar and place a bet on your favorite team. Well, you can bet on the stock market too, and if you have zero commissions, it's a lot cheaper. And there's a lot of stimulus too that actually, if you look at like the personal income, normally in a recession it goes down, but it actually went up during the recession. And I think that's because there was unemployment subsidies and just the straight checks from the federal government. So you have lots of cash, you have lots of time on your hands. You can't bet on sports anymore, and it's sort of and it's free to trade on the stock market. Those sort of all sort of combine. There's actually a guy who was the founder of like a online sports betting website, and like Dave Portnoy, I think.
Portnoy, yeah.
Portnoy, yes, and he's just basically doing the same sort of betting thing, but with the stock market. And he's making like social media videos and stuff, talking about he's piling into, I think it was AMC now, because he lost a lot of money at GameStop.
That's kind of scary in some ways. I guess far be it for me to judge other people's actions in this kind of context, but that doesn't fill me with a lot of confidence.
Yeah, there's financial writers that I follow who think this zero commission thing was really, really bad for the market as a whole, because sort of the role for the market is to have a price that sort of accurately reflects how well the company is going to be using capital and growing people's wealth. And so if we make it too easy for people to just pile in and out, that price becomes less useful for us in terms of allocating capital.
Okay, so
Yeah, so
what I'm interested in now is something that I touched on earlier, is this idea that the Melvin hedge fund could somehow lose, I think, $4 billion when last I looked. Maybe you've looked since I looked. But how is it possible that a hedge fund loses $4 billion on a short squeeze of a stupid stock like GameStop, which is in the, whatever, $6 or $7 range when this all took off?
Yeah, so the only reason they can lose that much is because it's an unlimited loss. So otherwise they would not have been able to lose that much money. But if you sort of do some quick mental math or back of the envelope calculations, let's assume they had 10 million shares sold short, which is a lot, but there was about 50 plus million shares sold short, and we know they had a big position, so it's not impossible that they were that heavily short. And let's further assume that they sold in at $10 a share, and they got out at 310. So they lost 300 per share. They had 10 million shares. That's 3 billion right there.
Oh, wow.
And they might have gotten in at a lower price, because I think the lowest price was like 250 in the past year for GameStop, and the price did spike to above 400. So we could sort of make it even worse and get it up to like 4 billion, just from those losses alone.
So just by scale, the math checks out,
Mhm.
right? Now you're
Yeah,
saying-
you can get up into the billions, if they covered at the highest price and they were bought in or sold in at the low price. Now, normally the hedge fund professional traders, they're going to have risk limits, and they'll be forced to, by their risk management team, to kind of close out their position when it starts moving against them. Maybe GameStop just spiked so fast that they couldn't do it in
Seems
time.
likely.
There's also a couple other ways that they probably lost money too. So they were selling short. They were probably short for a number of months. Like, I remember when I was teaching my investments class in the fall, I was teaching about short selling. I looked up who was most heavily shorted. GameStop was number one. And this was back October, September, something like that. So they've been heavily shorted for a while now, and you have to pay interest. And it's a pretty risky loan, so your interest rate's really high. It's
Right.
like credit card interest rate high. So there's a big carrying cost for the short sellers. And then, assuming that they were putting in cash to sort of have extra collateral, the hedge fund's not going to have not going to have billions of dollars of cash just sitting in their bank account. They have it invested in other places. So they had to sell those things. They had to sell them really fast. Usually at a bad price if you do that. So they probably took some big losses with all their other investments because they had to sell real fast. And I don't know if they include that in their how much they lost. Maybe they do, maybe they don't. But that probably adds hundreds of millions, maybe billion. They might add a billion or more potentially, depending on how bad it was for them.
Okay, so I heard some news that was talking about, and I think it might have been Citadel, but there was another firm that sort of came, and bailout isn't really the right word, but put some money into
Oh
Melvin
yeah, I
to
think
keep
that
some-
was Citadel.
It was, okay.
That they invested like $1 billion or $2 billion into the hedge fund. Yeah.
Is that all? Just $2 billion?
Just $2 billion. and that's probably because the hedge fund was really struggling to have enough cash to cover their short position.
But that's
yeah.
some kind of signal too that they think, well, it's not that Melvin did something wrong and then they were doing something dumb and then they got caught. It's just they're thinking this is like a once in a century kind of event, and it's not likely to happen to Melvin again, or
Probably. Well, so everyone is pretty confident that stock price of GME is going to come back down. So if you can get in when it's at $300 a share and you think it's going to drop to like 20, 30, whatever, there's a big profit potentially there from going short. And I'm sure that Citadel had some very generous concessions from the hedge fund that they gave the money to.
Citadel's looking to make money off
Yeah,
this.
they're it's not a they're
Charity.
not really buddies. It's not charity. It's the pros on Wall Street are ruthless, and they'll happily take advantage of the retail guys. They'll happily take advantage of each other too if they can.
So this is that kind of classic every Wall Street movie you've ever seen. They always talked about sharks, right?
Oh yeah.
Yeah. So there's blood in the water.
Oh yeah. Definitely.
So-
there was definitely blood in the water for the hedge funds that were initially short. Yeah.
I had this, I had this notion, and I think about these kind of things sometimes, and I have some other ideas about what I would do if I sort of had a set of money that I would like to do my own things with, not my retirement money, but money I would be okay with losing in order to kind of, maybe you could accuse me of gambling, but just sort of play with this kind of thing, and because it's something that it's interesting, and a lot of people find it interesting. And so I had that thought go across my mind that was like, it's not for somebody like me, but it's probably pretty smart to go buy a short option now when it's $400. Right?
So I have a small account where I do that, where I make trades. I don't day trade. I usually say I think this company is undervalued and I buy it and I expect to hold it for years on end. But I saw that and I was like, hey, it's going to have to come down. I'm going to buy a what's called a put option on GameStop. So
What's the difference between a put option and a short?
So a put is you have the right to sell at a certain price, and a call option is you have the right to buy at a certain price. So if you buy a put, first of all, your loss is only the amount you paid for it. You can't lose more. And if the price goes down below that strike price, then you can sell it for higher than what it's currently worth, and you basically pocket the difference. So I'll see if my put actually works. It expires on Friday, and if GameStop continues to go down a lot, the next day I might actually make money. Otherwise, I'll probably lose money. But that was just a small amount of that total account, and I was like, okay, I'm willing to risk a couple $100 on this. If I lose it, it's okay.
Yeah.
But if you're betting your entire portfolio on that, that's a very risky and probably not going to end up well for you.
So my suspicion is we're going to hear that type of story come out of this a week or 2 weeks or a month from now, and Joe investor is going to have lost $100,000 out of his children's college fund because he's buying shorts, or he's buying GameStop and didn't get out soon enough or something.
Yeah, that's
probably variations of that story. Comment on that and the retail investors and their general badness at investing.
Yeah, so when I was looking at the Wall Street Bets subreddit, I did see a couple of people who were saying like, oh, I think one person was like they're using their student loans to buy. Yeah, and I was like, oh my gosh, this is going to end horribly for this person.
Yep.
Also, you probably committed fraud because your loan probably says you're supposed to spend it only on your college expenses, not on trading in the stock market. But yeah, that does tend to happen when you have like a big bubble or something like that, where retail investors pile in. They invest too much, or they borrow, which is generally even worse than just buying with your own cash, and then they get burned. And yeah, it's really sad and awful when that happens. That's actually kind of the impetus for a lot of the financial regulation, is to try to prevent that from happening. So like the retail investors aren't allowed to invest with the hedge funds, both because the hedge funds don't want to deal with small sums like that, but also because hedge funds can blow themselves up like that, and you don't want grandma's retirement account to go to zero because she made a really bad decision there.
So let's talk a little bit about and I hope I've got the name right, but the person that we had talked about earlier, the Gil character. I had read something this past Friday that said something to the effect of they were in for 45,000, and then it was up to $1 million, and then I'd been updated as this week went on that somehow got to like $45 million. Now,
Yeah.
that's in the value that they're holding the GameStop in, right? So they need to sell in order to actually realize that at some point.
Right. Right.
Talk to us a little bit about that process and whether that individual seems ready to basically just be content knowing that he cost Melvin $4 billion, or is he actually trying to make himself a lot of money?
So that guy was actually posting every day like his amount, or a screen. It could have been a doctored screenshot, so you don't know for sure if that's really his amount. But yeah, so he both bought stock. He also bought calls, according to those screenshots. And some of those calls had expired in the money over time, so he actually had like a huge amount of cash too. I don't know if he bought more GameStop or not, but yeah, at some point, if you're in like a short squeeze like that, you have to sell, and you want to sell before everyone else starts selling and starts bringing the price back down. Timing that is just so hard, and you pretty much no one is able to reliably,
It's impossible.
pull that off. Yeah.
So we'll be looking for that story to come out next week or the week after, and we'll all eagerly read to see what he seems to have made.
Yeah, I mean, if he really did have calls that expired and he got cash for them, and he kept that cash, and he has, then he'll have made millions of dollars, from this event. But most people, if they bought and then didn't sell when it was high, they probably ended up losing quite a bit.
And I think there is some of that where it was $6 or $7, and then somebody sees it go up to 200, and then they buy, and then they see it to go up to 400, and they think, man, I'm really killing this. It's got to go up to 600, 800, 1,000.
Yeah.
But 400 was the high, and then it turns around and drops back down, and hopefully they get back out before it's 200. But in some sense, at that point, somebody's losing here, right?
Yes. Yeah,
So-
so the reason they were so confident or on that subreddit anyways was that, well, they're sort of kind of cornering the market because there's no one available
Right.
for the shorts to buy from besides them, and then they can sort of just name their price. It's kind of like they're playing a game of chicken with the hedge fund, except they have, they're all sort of different people. It's not just one person competing with the hedge fund, so that's a disadvantage for them because if a couple people, break ranks and decide I'm going to cash out now, then the whole thing can collapse.
Right.
But on the other hand, the hedge fund has to pay interest, so they have someone sitting in the passenger seat maybe who can reach over and sort of grab the steering wheel,
Right.
because their lender wants them to to pull out and to avoid the lender getting into that car wreck.
I'm glad you brought that up because that really highlights this idea, right, that they're trying to corner the market, but they're all colluding, and the higher the price of that stock goes, the higher the incentive to cheat. If we were to use the
Yeah,
econ
kind of a
lingo
game
of
theory
collusion,
thing.
exactly.
Yeah.
And so that deviation, or you called it breaking ranks, becomes higher and higher incentive until eventually it comes crashing down. So the people who are in it most to stick it to the hedge fund and not make money for themselves, the most pure amongst them, I guess, they're the ones that end up taking
the ones
big
who
loss.
end up holding the bag and losing the money. Yeah.
But it's sort of interesting because if you're a first mover, suppose that I buy, and I bought at $6 or $7, and it goes all the way up, and it comes all the way back down, and then it's there at $6 or $7, right? I guess I didn't lose anything.
You didn't
there.
lose anything, but
It's-
probably psychologically you took
Correct.
a big hit because those big price swings can really affect you. I know, like with my small short position, like I was, it was too much risk for me. I should have put in less because I was just constantly looking at the GameStop price, and I needed to get work done.
This is your behavioral
Yeah.
finance coming back around
Yeah.
again. When you buy stocks or you buy put options or you buy shorts or something, buy enough that if you forget to check for a day, you don't panic. Yeah. Okay.
Yes,
So there you
definitely,
go.
definitely.
So we've learned two things.
Yeah.
But,
Yeah, and another point about going back to the regulations. So that sort of collusion to sort of corner the market, that would be illegal. If a hedge fund tried to do that, they'd be again facing legal consequences. There's some examples in history of people that tried to do that. There's a famous incident back in the 80s. The Hunt brothers tried to corner the silver market. They ended up losing their fortune and going to jail for that. So. Again, they're making all these disclaimers about how it's not really advice, but if I
there's
don't
a
know,
wink and a nod that comes after.
there's a kind of a
right?
wink and a nod with that. Yeah, so that could be dangerous for them legally.
Okay, so I want to finish up with a couple of little questions here. We've talked a lot about the collateral and why that had to happen, so I think we've covered that. But another question that got asked to me is, how can there have been so many stocks of GameStop going around when it seems like there should have been a set number of them? So kind of explore this idea of there having been, I think there were 120% of GameStop stock being shorted. That seems like that should be impossible to the observer. So explain the
Right.
back of the envelope map
Right.
to us. there.
So first, how we know about the short selling. So the short selling gets reported twice a month. So if you see the short selling data, it's probably a week or two old and out of date. But it is actual data. Like the financial firms that are required by regulation to report the short position, and that gets aggregated to the company level, and then released to the public. Now, the reason it was over 100% is because it was being compared to the float, which is something less than the total shares outstanding. There's some people, like probably the Ryan Cohen guy who bought into the company. Their shares are sort of locked up. They're not going to be traded, and so the float is kind of our estimate of how many shares are available to freely trade on the market. So that there's like insiders who are not allowed to trade because of insider trading rules. Their shares would not be, say, included in the float. Now, the other reason you can have so many shares being sold short is that, say, I borrow a share from you and then I sell short. Well, the person I sold it to can also lend it out to another person and have that same share be sold short again, and you can keep doing that over and over again. So shares can be sold short more than one time. And that just sort of creates a liability where you have to go in and buy. So if that person that I sold it to, that position has to get closed out. So one person out there has to buy, and then I have to buy it as well. I can buy the same share, or a different share depending on who is selling it to me. So it's possible, in theory, for you to sell shares short, basically for an infinite amount, pretty much.
Okay, so we're over an hour now, so I want to bring this in for a landing. And the way that I want to do it is to take a question that was sort of general and was asked to me by a listener, a question that I liked quite a lot, but I want you to take it more of a philosophical direction. And so the
Okay.
question is, how can this type of episode happen, and why does that seem to violate the things that we've learned about finance? But I think from a technical perspective, you've essentially surrounded that question. So hopefully that listener's listening to this saying, okay, now that I'm seeing it all laid out by an expert, and I can sort of walk through the path. Yes, it's complex and it's kind of weird at the same time because this isn't a traditional story. But hopefully, I think at this point, that type of question is saying, wait, why does what I seem to have learned in my finance class not apply? I think we've annihilated that question. You've done a great job at that. So take us in a little bit of a philosophical direction and comment generally on how the finance classes or finance education, finance things that we're taking, and how we apply those to these specific situations, and just kind of a general comment about the philosophy of finance.
Sure. Yeah, so I think your listener was probably thinking of like efficient market hypothesis and how the prices should always, sort of accurately reflect the true value. And well, first of all, that's an hypothesis. We haven't really proven that. And I think there's some good papers that kind of say that you can't prove that hypothesis, period. But in terms of market efficiency, we sometimes will simplify it in class and say, well, there's a couple different versions of market efficiency, and we think the stock market is efficient. In practice, how efficient is more of a spectrum. So if you have, the more people you have trading, the more volume of trades you have going on, kind of the easier it is for that price to really converge onto the right value, and the harder it is for some weird technical thing like this to cause the price to go in crazy directions. And actually GameStop is a pretty small stock. It was well below 1 billion in market cap, which that sounds like that's actually big, but compared to something like Apple, which has over 2 trillion in market cap right now, it's really a pretty small stock. And we do tend to see that when we have a small market, efficiency is harder to get, and there's more friction in terms of getting the price to match the true value, and it's easier for some weird event like this to kind of spike things in the wrong direction. And eventually the market will come back to the right price, but it might take longer than it would in a more robust market.
I tried to promise you that I wouldn't interject when we got to this part of the episode, so I'm going to go back on my word there. And the reason is this: I'm glad you took this in the efficient market hypothesis direction, because one of the things I was just teaching in my micro class is this idea that markets are actually better understood as a process. And so the consequence of that, and this is probably a whole nother topic for a whole nother episode, but the long and the short of that, no pun intended here, is that a snapshot of a market at any one time really doesn't tell us very much about the efficiency of the market, because the market is a process. So all these steps that we're seeing in the actions and the reactions and the back and forth of this is part of how the market process irons itself out. And I think that works just as well for financial markets as it does for markets in general. So comment on that really briefly, and then we'll close it out.
Yeah. So one of the things we talked about with market efficiency was like how quickly the market corrects to the right price. So how fast it responds. So kind of how quickly does GameStop go back to the kind of the rightish price is sort of how one of the ways we would talk about how efficient the market is. So the fact that it's coming back down to I think right now it's around 60 or something a share, so it's come down quite a bit from that spike. It's kind of a sign that things are fairly efficient. It's only taking a week or two before we go back to normal. And there was sort of a real legitimate reason for the price to go that high. There was people that had to buy. It wasn't because of the fundamental valuation, but there really was buying pressure from buyers that pushed the stock price up. So the normal supply and demand was still kind of working. It just didn't match the fundamental valuation.
My guest today has been Eric McKee. Eric, thanks for joining us on EconBuff.
Yes, thank you, Lee. Very good conversation.
Thank you for listening to this episode of the EconBuff. You can find all previous episodes on YouTube at EconBuff Podcast. You can check out our website at econbuffpodcast.wixsite.com. That's WIXSIT.com. You can contact us at econbuffpodcast@yahoo.com.